welcome to the NISM Masterclass. I am your host, Sashi Krishnan. We at NISM are in the business of capacity building for the security market ecosystem. And as part of this objective, we sit down with gurus of the securities market and try to understand their journey. And I'm sure that all of you who choose to participate in this masterclass will learn a lot from the journeys that our gurus have had. Today, my guest is Dhirendra Kumar. And Dhirendra Kumar is a name that nearly everybody who has been an investor in the Indian securities market and in mutual funds have heard of, have seen in his various podcasts and his videocasts, and have read in the magazine that he runs called Value Research. Now, Value Research is one of India's most trusted and, if I may say, independent investment research firms. And I think the key point is independent investment research, because they have been able to give people a bird's eye view of how the mutual fund markets look like. And I think I have known Dhirendra since 1992. Welcome, Dhirendra, to this show.
Thank you.
And I think way back when Dhirendra started his career in 1992, he came up with this very brilliant suggestion of rating the Indian mutual fund industry. And I think that was a very, very different thing that happened in those days, because most Indian investors at that point of time were not only not aware of what mutual funds were, but they just did not know how to negotiate this space of mutual funds. And I think Dhirendra and Value Research have kept up with the times for the last 30 years since when he began tracking the mutual fund industry. I mean, Dhirendra has now morphed into being what we were just discussing over lunch, to be almost setting up a robo-advisory platform. So he's kept up with the times and not got sort of frozen in time as many other people who got into this business. So Dhirendra, I just wanted to begin with my first question, and that is, you have been in this advisory business for the last 30 years, and in this entire 30 years, you've stuck to this business. I mean, weren't you tempted at some point of time to move into setting up a fund management business or setting up a distribution business? Why did you see this as a very important space that you wanted to be in and live in?
Sheer accident. The creation of Value Research was an accident. It created entirely out of curiosity or boredom, so to say. Value Research in 1992 did not exist in the initial months. And what happened was, the great Indian scam happened.
Right.
Most of the mutual funds which were listed, they started trading at, premium, master share, can growth, Magnum multiplier scheme 1990. And when for the first time I tried to probe further, tried to find out that what is going on. Here is a fund which was launched a few months ago and now, or last year, and now it is trading at 16 times at 160 Magnum multiplier scheme 90. Incidentally, I was in my final year of graduation in 1990 when I persuaded my parents to invest in that fund. So I was very curious for a vested interest that, I was wanting to know why this money has grown 16 times in the market. And this was a completely imperfect market. There was no basis to it. When I wanted to find the NAV of it, the rule of NAV disclosure for mutual fund in those days was disclose your NAV every 3 months, and that too with a 3-month lag. So, quarterly NAV with a 3-month lag. So what you could get was, a stale NAV. And that too for reference, it had nothing, and you could buy or sell anything from the market. Mutual funds were not available on tap. They were not open-end funds. That was the beginning of Value Research, creating a scorecard and moving from there on. So what happened was I realized the impact of my work in the marketplace, on individuals' life, in my own family's life. It wasn't a game for me. I was not attracted to the market for the glamour of it. I was attracted to the market for its ability to make an impact in people's life, because I found that, in those days, a lot of people say that mutual funds have become very popular. I think mutual funds were even more popular in the 90s. Reason being, despite the absence of, the private sector mutual fund. Because SEBI came into being in 1993, and before that, 8 mutual fund existed. UTI,
Right.
SBI, the
Canara
5 public
Bank
sector
and-
bank, and GIC and LIC. So if you had those 8 mutual funds, and it was a household name, for whatever reason, without the regulations, and because in those days mutual funds were serving a purpose which is not being fulfilled today, or they are not needed for that today. In the 90s or early 90s till the mid 90s, there was no way individuals could access the stock market. They could not invest in the market. These vehicles were actually making it accessible to people which was otherwise not accessible. Unless you had 50,000 rupees, 1 lakh rupees, 20,000 rupees, which was big money in those times if you adjust it for inflation. Then only a broker will entertain you, else not, because broking was a risky business. You can have bad deliveries and things will not work out. The brokerage was 2%, a laughable amount. But today,
Yes, I know.
So if you look at this, look at Master Gain. In 1992, they raised 4,500 crore from 65 lakh investors. Now, if you adjust this 4,500 crore by today's Sensex, it will aggregate to about 90,000 crore rupees NFO.
Right.
A closed-end fund raising money and raising 90,000 crore, because then the Sensex was at 4,000, the peak of it at the Great Indian Scam, of 1992. Right. And multiply it with 20 times, and this will be 90,000 crore, which is unprecedented and unheard of money. It was the largest in those times globally, and it will be largest even now if you adjust it by that. So I would say that mutual funds were very prominent. I realized it much early. Maybe I realized it way bit too early. It was little ahead of time, because mutual funds, I was very confident that one day they will become a mainstream way for people to save and invest. And it just took much longer for it to become meaningful. And I was able to devise a modest, revenue stream for myself by doing something which was not an investment business. I was able to find customers for my data, for my information, for my writings, for my opinion or commentaries. And those early years, 92 to 2000, before the emergence of internet, I was in a state where I was actually a commentator, and that is when maybe it did hit me that I can't be a referee and a player as well. And there was no business model to support it.
Right.
If you wanted to be an independent advisor, how will you support it? Because there was no sell side research was the only mechanism.
Right.
So you could be a mutual fund agent, you could be a stockbroker, but you cannot be a commentator. You cannot be an independent provider of research. Only now it has become possible that I can have a business model which is supplemented or supported by a regulatory framework, whereby I can give research, find a customer, give opinion on things, and make people pay for it. And there is a legitimate framework for that.
If I may interrupt you, then you do think that there is a future for people who want to become registered investment advisors, because there is a large constituency that's available at this point of time, and investment advice is very, very important for people to create wealth.
Yep.
And therefore, now there are career possibilities in becoming registered investment advisors.
Yes, there are immense career possibilities. And not only that, today the scale of business that can be done either by being an intermediary of a right kind, because today the information explosion that we are witnessing, it is revolutionary. Because if you look at what used to happen in 90s, what used to happen in 2000, that decade, and now, 80% of our effort was going into the logistics of managing the transaction. I remember, the Master Gain launch, and UTI was struggling in handling the processing of those applications because it just was too many. 65 lakh people, 1 out of every 20 Indian invested in that fund. So if you look at it, I was told that, Thematic, which was the registrar service of that company, that the person who runs that company, he told me that, this is, if they had a football ground, and if there were 20 people, and if you actually created a card for each and every application to verify the signature, there will be 10 rows of that, and people running on this, skating shoes will end up handling one in a span of 5-7 minutes. So computerization, digitization, the world has changed. So I think what used to go then, collecting form, getting the form filled, banking it, and then waiting for the collection, and that getting processed, and you getting the certificate, mutual fund certificate, you never got an account statement. So in that sense, it has been revolutionized. Today, what you can do with your time and your effort and with your guidance is completely different. So it is not about just, you can be an advisor without being an advisor, and you can do a great job and build a large practice. Likewise, you can be an independent advisor and make a case for yourself. It's a business model which you have to choose, but it's possible to do things on a different scale given the catalyst that we see in the environment today.
So just taking a step back, you've been in the securities market for the last 30 years. So can you just tell me, two of those highs that you saw in the securities market over the last 30 years and two of those lows, which, have deeply impacted the way you look at investing and the way you have been advising your, constituents?
For me, the high was 1992. That was my first brush with the market, or that was not the first brush, but I've actually experienced it because I persuaded my parents to invest in Magnum Multiplier Scheme 90 and one or two Can Bank funds, and that went up by 15 times, 20 times in the market madness. That is when I realized it for the first time. And
that mutual fund was the right way to create wealth for yourself.
Yeah, that was one, and then I realized that mutual funds makes market accessible, which is otherwise not accessible. My parents were living in Patna, and my father was posted in West Bengal at that point in Calcutta, and it was not possible for him, even if I would have told him. Imagine the telephone lines or the kind of, you went to a steady PCO booth to, make a call and book a trunk call, and those were the times. So in that sense, making, democratizing market, mutual fund looked like the only sensible vehicle. And 1992, and for me to understand that market was not a glamorous place where, a lot of people come for fun or, to multiply their money or do some magic with their money. It had a real life consequence. It had an impact on our education. It had an impact on my sister's education or our marriage or, their financial security or buying a home. So for me, the financial security turned out to be very real things. It was not something which was abstract or, a fun allocation or I feel happy that, okay, I made money. And so 1992 was one great thing. And then the period and then 1992 to 2004, market went nowhere. It just went up, down to achieve that same 4,000 level in 2003.
So no highs for a period of 10 years in your life?
For a period of no highs. No, but I had two great lows, which I can recall. That was one. Then 2001 was the great low because, what happened was the market got very narrow. FMCG, technology and healthcare businesses were the only drivers of the market. Everything else was, down in the dumps for years together. But that was the result of reform. That was the result of the interest rate reform or, many things which was happening in the economy. And we can all say with perfection, with hindsight, but now but at that point it was very frustrating that a lot of people invested so much money through IPOs and this and that and excitedly, and nothing happened. Master gain was a struggle for 10 years,
right?
Though everybody invested, or Morgan Stanley and things like that. So the technology boom, which actually took a segment of the market, and then Y2K and the global that decline was something which was very unnerving. That was unnerving also because your experience as a bystander and your experience when you have a stake in it is very different. You could actually feel it. So that was one. Then the big high that I saw was, the period from 2004 to 2007 and 2008, before the global financial crisis. The market went up from 4,000 points to 20,000 points. That was the unprecedented thing. That was something which I saw that was actually the foundation of the market that we see today, because people experienced it. We saw excesses in the last leg of that, but I witnessed that mutual fund was becoming mainstream. The technology was falling in place. The payment system was falling in place. So there was this beautiful ecosystem which was evolving, and mutual funds were able to ride it. But still, mutual fund remained a very cyclical, seasonal, or people. It was not a methodical thing. Then the global financial crisis and saw the decline, and that decline from 20,000 points to back to 8,500 on Sensex
was almost like a deja vu moment for you compared to the 2000s, right?
Yes, it was. It was very unusual, and that is when we had also access to or connect with a large investor base. A lot of people. We get plenty of questions every day, emails, and people are asking us questions. We were advisor to some big institutional investors, and who were only investing in mutual funds. We were ourselves advising. There were no regulations for advisor, and we were ourselves advising 2 foreign fund of funds which were investing in domestic funds, because India was in the limelight, in the prominence. So that decline, and then I saw that the impact of that, and so we really have the great experience of being in the middle of these big ups and downs, and that has also helped us formulate our principles of advice which will withstand the test of time, because whenever I come across a situation or an investor's question, or somebody seeking advice, we really understand that because investing is so much about what not to be done. It is not about what to be done. Very few things to be done, but 100 of things not to be done. And we can always, it was a great period for us to absorb all that.
So this period from 92 to 2012, 2014 was a roller coaster. And I think what you learned from the conversations that we just had was that you need to learn how not to be giddy in that roller coaster. But 2014 to 2024 has been a relatively, calm, steady upward movement in markets for most times, right? Right. So have now investors, come to believe that, this is how the markets will be for, times to come. And if I may, ask you to indulge in a little bit of crystal ball gazing. I know that, people who do crystal ball gazing invariably land up eating ground glass, but I'd still ask you, if you needed to do a little bit of crystal ball gazing, how do you see 2024 to 2034?
From now to 2024 is not crystal ball gazing.
No, from 2024 to 2034.
2024 to 2034, this is not crystal ball gazing, because this is something which I can do with
great amount of clarity.
Great amount of clarity, because I think we might be very happy about what has happened from 2014 to so far, but these are still formative years. I still don't find people in my neighborhood who invest in mutual fund. I still feel that there are a lot of people. Mutual fund is one segment of the market where anybody who has used it in a small way, you will have plenty of happy stories. This is the only segment where you have happy stories. Everywhere else, you will have a mix of stories. I haven't come across anybody who has done a SIP for 3 years and can say that, oh, he lost money. So that is the first step. Second is that were you able to beat inflation? Third is that were you able to, and I think it is a beginning, because very soon we might end up with a low interest rate regime. I think low interest rate regime, and given that we have this small savings organization which gives you a sovereign guaranteed retail product like recurring deposit or senior citizen savings scheme or post office MIP, which is fulfilling most of your needs, and which is absolutely safe. You can't get anything safer than that. And it is available in the remotest of corner. It is completely democratized, much ahead of mutual fund. So in that sense, something which will help you have more, build wealth, and is simplified. And the design of it, what has happened, a lot of times people ask me about what is the interesting thing that is happening. I think the interesting thing that happened was 20 years back, or something like 30 years back, which was the creation of the open-end mutual fund. Because before that, you can only get up one fine day, and if you have 50,000 rupees, then you can invest. Here is something where, Kothari Pioneer Prima Fund was the first fund, which started. Of course, Unit 64 existed, but it had all the catch and everything. But in case of a real mutual fund where the NAV was disclosed every day and you could buy in, and I remember, that was the beginning of it, and you could give 12 post-dated checks. And everybody was awed by the whole design of it. And that was quite a groundbreaking thing. And now it has become mainstream. What has happened subsequently is that you can give a mandate where the money will be debited from it. The fact that you can actually use your cell phone to give this instruction, set up yourself and look at and democratization of the information, getting your anyway every day and, accessible to it. So information gives great deal of, reduces your anxiety. If you want to know about anything in great detail, you can. The fact that you can, otherwise you will have to travel down to some place to figure out what is happening to you. I've seen people, old people coming from to New Delhi in my early days, in the 90s, when somebody will come with a bundle of, his UTI certificates and SBI mutual fund certificates, coming down to my office to figure out that what to do with many of these things. He has an emergency, or, somebody's father passed away, or what to do with it, no idea what to do. Those things, I think, we have come a long way. And what has happened right now is just the foundational thing. People have just tasted these are the stage. A lot of people think that, we have arrived. Not really. I think this is just the early phase of that. And with this in mind, I'm very confident that despite all the hiccups, ups and downs, and, wars and any kind of mess that is going around, we can invest confidently for the next 10 years. I'm not very confident about next 1 year. I'm not very confident about 19 months or, next 6 months. But about next 10 years, I think, it'll beat inflation. And with a diversified fund, maybe, we just might end up being among the best, market as well.
That's a very interesting perspective, Dhirendra, because the first year that US 64 closed, that is in the year 1965, it was 25 crores. 60 years hence, we are now in 2024, the mutual fund industry is 61 lakh crores. And you are telling us that the foundation has been laid.
It's just the beginning.
So, that's a very interesting stake, from 25 crores to 61 lakh crores, and the foundation has still been laid. That means that, what will happen in the next couple of years could be, something that we really can't imagine.
I'll give you the warnings to the 61 lakh crore.
Right.
There is a catch that, nearly 1/3 or half of this money is from companies.
Right.
And that is not individual investors' money.
Right.
That money coming from companies was for a different reason. Maybe a part of that money will still remain. But not very long back, this used to be 65% of the total asset base. So ever since the decline, but I think, the mutual fund is especially useful for individual investors. This is the only guaranteed way of building wealth for the long run. Guaranteed way, don't expect that, I'm talking of any guaranteed return. But if you look at, if anybody does, recurring investment in the market through mutual fund, and how it has become even more relevant, because now you have capital gains tax. And the moment you entrust your money to a mutual fund manager, you are not liable for any taxes till you decide to realize it. And it could be 20 years, 30 years, a tax sheltered vehicle where your money lies there and it's actively managed. So I think, these are the reasons why I think it is still early days.
So what you're essentially saying is that for any investor, especially a first-time retail investor,
individual
investor, the best option for creating long-term wealth is the mutual fund space, right? But the mutual fund space itself has become a bit of a maze, Like, in spite of the fact that you've got 6 product categories, you've got something like 1,500 schemes and, 44 AMCs. Still a small number compared to some of the developed markets, but still for an individual investor in the Indian mutual fund space, it's a little bit confusing. So how do you recommend, or how would you advise this individual investor to navigate this space?
Oh, that is not very complex. Because, that is in all dimension of our lives. If you choose to, buy a shoe, even it could just be, as complicated. And, you can, Amazon is not actually just a retailing company. It is a company which helps you compare.
Right.
And comparison by different parameters. But I would like to, this is something which is little more complex. This is something which has even more consequence because you decide today and you have to decide for the long run, and that decision should be valid for a long period of time.
Right.
So in that sense, and there is a consequence for undoing it, reversing it, or changing course. So I would say that there are about 32 kind of funds authorized by SEBI. The open-end funds, 16 equity funds, 16 debt funds, and 16 kind of quite a few hybrid funds as well, and not taking into account the universe of index fund that could be launched beyond all this. So you will be in a state of confusion if you don't decide what to do, and that is something which most individuals, most consumers, most people who are making a useful or very important decision or making a choice. If you have to study today and you are getting out of college, today you have 50 options. You can well go into culinary studies, or which I could not have imagined, when I was growing up. So you have problem of plenty, you have problem of choice,
right?
But you have to choose. And here the framework for choosing is.
So if I may just interrupt, when you have a problem of choice or you have a plenitude of choice, it tends to paralyze you.
Yeah.
So how does
that is where I think
investor sort of.
I think this investor education or investor literacy or financial literacy or the basic framework of how things work, understanding of that is the only weak point. Even there we are in a state of infancy. The whole awareness about mutual fund came from that accidental mutual fund Sahi Hai campaign. It was able to raise expectation, and mutual funds, anybody who has experienced it, who has started investing his small sum of money, 500 rupees. One is that it is possible to do it. It is possible to do it with great ease. You can do it in 10 minutes flat. That is one thing. Second is that people did it, and it was able to provoke people to do it or explore it. And after doing it, they are finding it that yes, that is true. That is just reaffirmation that yes, it happens is just as important. Now comes, okay, let's go all hog, and you go and tell because there is no better marketing than your friend or your neighbor or somebody whom you trust telling you, more than the advisor, telling you that I did this, you should do it, it's a sensible thing to do. We haven't had this experience in the previous 30 years. People got excited about investments. Think of Master Gain, or think of Morgan Stanley, or think of the infrastructure fund, or think of the technology fund. Every 5-7 years, people got excited to invest only to get disappointed. Now people are not getting disappointed. In the last 10 years, the SIP book, which has arrived at, reached something like 20,000 crore every month, flowing into the market steadily, is something which is, creating great deal of happiness among people. People may take out, many a times I come across, this is still the most popular question at Value Research, that I invested, my money has grown, should I take it out? And sometimes people take it out. I have taken it out and market has gone up again, what should I do? So people are getting back again. And this was the case. In fact, till 2008, ever since, what happened in 2004 was somewhat similar. People were used to a drifting market for a long time. So nobody thought that market going up from 4,000 points to 5,000 points was like 25% rise, pack up and go home. Then at 5,000 points, the people who packed up and went home, they realized that, okay, now it has gone up to 6,000. So we'll come back again. So they were coming back again, and some people were going out. Likewise, so it happened. Now, this time it is, people are experiencing it in a manner where they are not getting disappointed. They think that it is a long-term thing. And even the awareness that you have to invest for the long run is far higher. So I think, that is why I feel that this is still in a state of infancy, more than any mutual fund Sahi Hai campaign or anything. I think simplification by advisors, simplification by tools like Value Research Online, simplification, being able to guide people, because, you will have 2,000 funds and you will have another 2,000 funds in next 2 years. But that is, instead, and this clutter will only continue. There are good fund managers still making inroads. But you need few of them. And those few, if you are able to, handpick them, with guidance, with understanding, and that it is now becoming far much easier. I think 10 years back, 5 years back, it would have been a little difficult for people to think that, okay, here is an app and I should be able to, it is guiding me how to do it. Once you actually start ordering food and then you start getting your taxi and then you start doing your SIP, then 3 years later, you just might start taking the advice also more seriously.
So, Dhirendra, normally when you go to an investment advisor, there are 3 or 4, sort of standard approaches he gives you. He'll say, set your financial goals. Easier said than done because, from where we come from, a lot of us even don't know how to go around setting up financial goals. And then he will say, start early, right? And very often, and I think we were again having a conversation before this, saying that most people who come in actually come in after the age of 35. So, I mean, again, easier said than done. And then we say small amounts of money month after month, the SIP example which you're trying to say. But you also say that there are a lot of people who see a new high and then they take out some money. So, how consistent can that SIP be? And then we say stay invested for the long haul. And most people don't even know what the long haul is because for many people, long haul is tomorrow morning. I mean, rather than, 20 years from now. So how do you, I mean, these are real life problems and, you've been there, seen it, advised millions of, people, both young and old. So how do you actually navigate these 3, 4, basic truisms, if I may say, in building up wealth?
Yeah, even the regulators say that you have to do the risk assessment.
Right.
And, there is some framework suggested or something like that. But I think, we, in the last 20, 25 years or 30 years of meeting plenty of investors, reading their questions, applying our mind to it, even applying our mind, coming with a suggestion and then realizing that it could have been perfected better or, thinking harder about it subsequently. We have arrived at, 2 things. Which is 2, 3 things, which is the most important thing. And this is something which only an investor himself can decide. One is, of course, you have to start early. Of course, you have, even before starting early, you have to save. Most people today, the biggest challenge is not about where to invest your money, but, do you save at all to actually invest your money? Because today we are living in a world where you get your first salary and somebody is standing by to enable you to spend your future income over the next 5 years, today itself. So you start with a negative investment to begin with, and that will be a consumption, whether you are buying an iPhone or something. So that I think is the first challenge. Second is that telling somebody to try it out, start investing anyhow. Once you start you think that you are saving. Then the problem is that, there you'll be inspired by your friend who will be doing something very magical. That, okay, he's coming and actually boasting about he doubled his money day before, or and you falling for it. And you don't really, these kind of initiatives are not done with that probity or, that kind of initiative that you will go and find that SEBI report which say that 92% of the investors indulging in this kind of nonsense are losing money. And even if you are in an age where you think that, okay, these idiots will lose money, but I'm going to be the 8%. Right. So, you start with that. And I think it is all a journey. That is how you learn. That is how you run, learn by, how to ride a bicycle or, in the markets. And it is better that you learn faster, learn quickly, fail faster. Because if you do it, you will realize what really works. And this is when, mutual funds come in. And that, initial years you can't save. Then once you start saving, then you do all this trading or try and do some magic. And then, many people are also, are in the second generation. People are not as poor or as marginal as the previous generation where somebody was earning to remit some money back home. Right. So, the general prosperity is also a little different from, in 1 or 2 generations. So, I think people should go through this whole phase. In the financial affairs, I have figured that you don't learn from other people's mistake. You have to lose your own money. Till you lose your own money, it does not register in your mind. Okay. And so one should lose fast and quickly.
So I think 2 things I hear you saying. One is experiential learning. Yeah. In your own financial management, your personal financial management. And the second thing I hear you saying is You need to convert people from saving to investing in a structured way.
In a structured way. And
Yeah.
the third
How do
most
you make that move from saving to investing in a structured way?
There I have, very clear forward. Everything that we are, that will you lose money? If you lose this much money, how scared will you? Will you start crying or will you feel happy? And all that, those things don't work. What really works is how critical that money is and what is the time you have. Because that criticality of that money, if that, we have broadly two kind of goals: negotiable, non-negotiable.
Okay.
My child gets into school on 1st of June 2025. That is the day, and I need to have that money handy. I plan to buy a home in next 3 to 5 years. If something, if it happens in 5 years, it's fine. If I get lucky with the market, I can buy it tomorrow. That's nicer. So negotiability of this. So negotiable, and how critical that money is. That criticality of money is in relation to your income. When I have experienced all these early in my career. I invested all that money in equity, and then I realized that that was something. If that scale of money is 10x your annual savings, right, it's very critical. If it is half of your annual savings, you will look at it very differently. That was your annual bonus which you have invested.
Right.
So scale of money, criticality of that. And then, your income scale, because, I think broadly people are into 3, 4, 5, income strata, which makes their life very different, which is a function of, how much surplus, overall financial, your net worth. Because if in all I have invested, been able to save about 18 lakh rupees, my whole world depends on that. 20% plus minus actually makes a hell of a difference. Right. It can actually mean my child goes to college or not.
Right.
It can mean, I'm able to live in my own house or not. So, because 20% of that 15, 18, 20 lakh rupees could be 2, 4 lakh rupees.
Right.
Because I have seen that, somebody able to buy a scooty for his son makes hell of a difference to their life at a certain stage of life. Whereas for somebody, it could be, a swing in the market of a certain scale, which may not be that material, or it may not impact him, or sometimes he may not even notice it. So this is real risk tolerance, your time frame, criticality of that money, and your own net worth. Because in relation to your net worth, because what is going to affect our life will be material. What is not going to affect our life at some level can also, reconciliation becomes easy. Right. You are not going to be deprived of something real. Right. So that I think is very important. And these are the only things which works in my risk assessment and framework of advice. And it has to be, and the guidance is entirely by changing the allocation and the preferences.
Yeah. So let me just come into a specific question. So say you had a 24-year-old individual investor. What would you suggest would be an ideal asset allocation? I mean, I know you will tell me that, I need more information. I need to know how much surplus and all that. I mean, because, I
don't need more information.
Typically people would say, I mean, if you're young, it must be equity. And that's very often what I hear investment advisors saying. If you're young, it must be equity. Why do you need to think beyond that? But what would you suggest? How would you suggest she looks at, putting aside money for building long-term wealth for herself?
I would not like to give any complex structure or even a lecture.
Right.
I would just persuade him that start investing today.
Right.
Before getting out of my room, get started.
Right.
And these are a bunch of good funds. Choose anyone which you like, if any.
Okay.
Don't think of anything.
No, not equity, not debt, nothing.
No, broadly equity.
Okay.
Ideally, I would like that, if I have a 45-year-old person walking in and investing for the first time, I will suggest him an aggressive hybrid fund.
Right.
But for this 25-year-old person or 24-year-old person,
right,
invest anything and do SIP.
Right.
And also do some lump sum in between.
Right.
Doesn't matter.
Right.
I think, it doesn't matter because you have to really learn the magic of compounding in some period of time.
Right.
And you have to experience it.
Right.
Once you experience it, because, the premium for choosing the best fund or the not so good fund, the premium for choosing an inappropriate fund like a sectoral fund or a thematic fund or a diversified fund.
I'll come to that a little later.
Yeah, there are issues. Yeah. I'm saying that, but if a person has been tempted and provoked to invest and get experience of investing, I think falling into habit is one of the biggest challenge. And falling into habit, you can fall into habit only if you derive the pleasure out of it. So my first attempt with any person will be very educative in terms of get him initiated in the way he feels happy about, and make sure that he has given a 12-month to 36-month mandate so that he can see witness the magic.
So Dhirendra, from what you were saying, I think for an individual first-time investor, whether it is passive or whether it is an actively managed fund, whether it is a thematic fund or it is a diversified fund, whether it is SIP or whether it is lump sum, is not so very important.
Yeah, getting started
is most important.
Is the most
Once
important.
you've got started,
Yep.
there are certain choices that you need to make. So very clearly, SIP seems to be a better option than lump sum. But if you do have money coming in, then lump sum is okay. But what about passive versus active, or directly or through an advisor? I mean, how would you, or a diversified fund against a sectoral fund once you become, a reasonably seasoned, mutual fund investor?
Direct versus regular is very simple. Whether you want to have an advisor or you want to invest through an intermediary.
Right.
And if you invest through an intermediary who is holding your hand in the transaction bit, I think their role is coming down. So consider, looking for an advisor and invest in a direct plan. That is the best vehicle. If that does not happen, then look for a mutual fund agent, because they are not available in large number. They may not be available in the neighborhood. And I think those advisors have they add a great value today, because the biggest thing that everybody gives you a financial plan or the appropriate, then the rebalancing advice, help you with the transaction. What really happens is that once in a while, the advisor has to behave as a psychiatrist, and he has to behave as a psychiatrist, and that is the most important moment in the life of the investor, and that is the most important role that he plays. And those moments are two. A moment like now, where everybody thinks that he has to invest right away because they are missing the bus. And fear of missing out and investing somehow wherever, and possibly picking the riskiest thing because that is yielding the most. And the risk is not visible as and when till it actually visits you. And, as it is said that, and that experience could be damning, can be devastating for many people, because markets go on a staircase and come in the elevator. So, and that is not going to change. That is the character of it, and that is how it will be. So that is one.
If I may interrupt out here, are investment advisors today equipped to play that role of a psychiatrist?
They are, but they are very few. Okay. There will be some in Delhi and Mumbai and Bangalore and Pune and
so
here
we
and
need
there.
To increase that community.
We need them in large number, and till they actually have experienced at least one full market cycle, till somebody has not experienced 2008, he will also be, he will just be fanning the greed and fear of the investor, and he's supposed to do the opposite of that. Then the second occasion when he has to really play the role of a psychiatrist is when you think that it is all over. Right. And when you look at October of 2008, when everybody thinks that, okay, it is all over, you invested your money in the small cap fund, you invested your 100 rupee, and now you are left with only 35 rupees. Right. And you think that you can't take it anymore. And that is when you need this guy, because they are useful on these two occasions. Right. And help you moderate and help you not go crazy on two extremes. Right. And otherwise, you can just carry on. And unfortunately, the most recent crop of investors, and in large number that they have come, they haven't experienced any of these two things. One saving grace is that anyway they are SIP investors. The SIP book that has grown is of a kind where investors will not be disappointed simply because they have experienced it. They have seen how gradual investment, because everybody has a capital. Because, we are missing out on one aspect of SIP which has gone unnoticed. People were not doing recurring deposit in the quantum they are doing SIP.
Right. That's an interesting observation.
And the advantage of doing this recurring deposit or SIP is that from a regular cash flow to be able to build a capital is something which Indian investors have not experienced, even though they were a saver.
Right.
They were actually letting their savings accumulate in their bank account.
Right.
And that was a gentleman's way of looking at it, savings or investment or whatever it was. Now, compounding at a higher rate,
Right.
and a sum of money which was not there in the first place.
Right.
When you look at, you have 5 lakh rupees which you thought that, you will never have, and it's all started with a 5,000 rupee.
Right.
Is quite magical. You start believing in it. Sometimes you misbehave. You spend it on things, which could be impulsive or which may be not justified, but it is all fine. That is what you have money for. You don't have to be right all the time. If you have time on your side, but this is the beginning. And I think it is very important that people start somehow and do it for 2-3 years, and rest of the things get sorted anyway.
But what about passive versus active, if I may ask you?
I am an active guy. I still believe that there are people who will be able to beat the index by a modest margin or a very high margin over a long period of time. And if I'm going to invest for the long run, I feel that in India, because the Indian market is very broad and it is not very deep, and there is not much value to be added, and the good indices are only in the large cap universe. In fact, you don't have credible index, the small cap index. Okay. You don't have credible micro cap index. I don't know how scalable they are.
Right.
Some of them will actually be dysfunctional if somebody gets 5,000 crore to be invested in a micro cap fund of 250 stocks.
Right.
Because in a country where promoters still own nearly 50% of the stocks, of the outstanding shares in any company, it's very difficult. Then comes, so I would say that don't wait your experience or your habit to be held by this dilemma. Start anyhow.
Right.
In fact, the value, assuming that you will earn 20% more than the index, it is better to earn the index return than actually put your money in the recurring deposit or not. There is a penalty for not starting today,
right,
not allocating. So don't get into this debate. Even if you are debating this, get started. Not a good fund, maybe an aggressive hybrid fund, even if it matches index return, that will still be a steadier take on the downside. Everybody is not
so
as...
if you say that active funds do make some sense, you've got some thematic funds that are being launched, you have sectoral funds that are being launched, there are diversified funds that are being launched. How do you then decide as to which suits me best?
No, they can be avoided very safely, and you will not miss out on anything if you are avoiding all the sectoral funds. Mm-hmm. And in fact, not only that, I can tell you with full confidence that last 20 years we have seen the launch of sectoral funds or thematic funds in the last 25-30 years. I don't think there is any new sector which is making a comeback. In fact, the current rush for sector funds or thematic funds is entirely because of a technical reason. SEBI has said that you can't launch another large cap fund anymore. You can't launch this fund. So if people have exhausted their quota of their fund launches, so they are asking some index makers to go and manufacture an index so that they can launch a fund. And investors are still, guided by some of those naive, not so intelligent understanding that they're buying a new fund cheap at 10 rupee. Also, in good times, it is much easier to sell a story. And everybody thinks that a story, if it is credible, and investors' favorite pastime is chasing recent past performance.
Right.
So you can weave a story around something and it will sell. And we should not forget that mutual funds are primarily dependent on raising as much money than managing it very well. Mm-hmm. Their substantial revenue depends on raising money and keeping it.
That's a very interesting take. Yeah.
So, and after that, if it does okay, they are fine. If it is not very disappointing, they are still okay, because they will make good part of their money. All that will, but if the fund does very well, then they stand to benefit. Investors also stand to benefit because they get a small part of their assets under management. Right. So, I think investors should be extremely careful, and you will not. Last 20 years, I was referring that there was a PSU fund launched in 1990s, right, mid-90s, right, or you look at the MNC fund, or you look at every time there has been the flurry of activity around sector funds and thematic funds. It has been a warning bell. It has been a short-term or a medium-term warning bell, whether it was in technology fund, infrastructure fund, or anything in the past.
So if I may sum up, I think there are 4 things that I learned from the last few minutes we had this conversation. One is get started.
Yep.
It is not important as to
How,
where, how, and just get started.
Somehow, yeah.
Somehow get started. Second is that you do seem to think that if you are going to be invested in the market over 30, 40 years, then active funds still make a lot of sense.
And the diversified ones. Yeah. And there are 5 categories, official categories.
Right.
One is large and mid cap fund,
right.
multi-cap,
right.
flexi-cap,
right.
value fund,
right.
and tax saving fund.
Right.
Any of these categories, it gets you a broad exposure to the market.
Yeah.
And
so active and then diversified.
Yeah.
And then I think the other message that I got was that there will be times in this market when you need to consult the psychiatrist.
Yeah.
And when I mean the psychiatrist,
the advisor has to play the role of a psychiatrist.
Like you or somebody like who's an investment advisor, because there will be highs and there will be lows, and when you have highs, you tend to get exuberant, and when there are lows, you tend to get depressed. And if you do have an advisor, I mean, it'll go a long way to.
He will help you navigate it well.
Navigate that very well. Now, just moving on to the securities market, there are 2 observable facts which can't be disputed. One is that the number of Demat accounts now seem to exceed 15 crores. So there is a huge spurt of Demat accounts that have happened over the recent past. And the second thing is that derivative trading, you did mention it a little bit before, but almost 41% of the total derivative trading now is retail. Now, does that, in your opinion, portend to a change in behavior where people are now willing to take more risk? They are willing to put more money at risk in the hope that they will earn significant wealth in a shorter period of time, or is it just a trend that the younger generation now sees mutual funds as a lot more boring, and they think active equity investing and active derivative investing is more exciting? So why do you see this trend happening?
3-4 reasons. One is that market has become very accessible. If you choose to invest in F&O derivatives, you can prepare right now, and tomorrow morning at 9:30 you will be all set. Second is that it's great fun. Mm-hmm. People are because it's a leverage trade. Your ability to magnify your returns because it's leveraged.
Right.
And we have seen the rising tide over the last 10 years.
Right.
So most people, if they are for a brief period of time, it's fun. Second, and the third is fun only. Right. A lot of people are just doing it for fun's sake.
Right.
And fourth thing, it could be it's simply because people have also become more confident about themselves. Mm-hmm. If I have my 5,000 rupee and my whole world depends on that, I really don't wonder. I wonder I will be doing F&O trade. But if I have a 5,000 rupee and I'm very confident of my future, and I say that, okay, I won't go, I won't go for my dinner for 2 days. That's okay. I think, the relative trade-off or the worth of that money.
Yeah, but I think what I hear you say is that this journey from fund to fund will happen in the course of,
if you don't get it.
As you get more.
If you don't get addicted.
Yeah, if you don't get addicted, it will ultimately happen. And so we don't need to get too.
That is what we imagine, even with alcohol, that, if you have it for a while, with your friends and all, it's fine. If you get addicted, it's a problem.
Right. So just another, related question. Do you think that, there is now a better understanding of risk, especially risk associated with, various investment instruments, and this understanding of risk will help people manage their portfolios better and create, sort of wealth for themselves in the long run?
No, people are not, people don't take risk very seriously.
Okay.
And investors' thinking is very malleable. Mm-hmm. Investors are also very forgetful. And, the same greed fear cycle drives. So you have to really figure out, you have to be, doing your SIP and your ability to increase your SIP with your rising income and being disciplined about your savings and investment is a great act of discipline. I don't think it is a casual thing. Right. And most Indians were habitually savers. That is why we are finding that, okay, habitually savers more rewarding. We are finding bigger takers for that. But I'm not sure that, risk is understood, because risk is something you can't comprehend till it hits you.
Right.
And the same impact at different phase of life, if assuming that you lose 5 lakh rupees when you have 50 lakh rupees, or you lose 5 lakh rupees when you had 7.5 lakh rupees,
Right.
it will have a different impact.
Right.
Percentage, even if you look at the percentage, the scale of your investment will have a different impact. So our risk is also a very moving target, our perception of risk. And so I think, risk will never be understood. Greed will be understood. You can always compare yourself that, oh, if you wish you had this, and that will also never be an end. But I think everybody has to find his baseline risk, what he cannot do. And that is something which advisor or a mechanical process, because we are witnessing a degree of automation, a degree of empowerment, enablement. Why can't, for example, if there is a child who is using a credit card, we can always block, we can make a standard rule that, okay, transactions above 750 rupees will not be done through this. Likewise, depending on time and depending on income, I think it can be well programmed.
Right. So,
I think this should be a regulatory initiative.
what is risk for me is not risk for you.
Yeah.
Right. And therefore, the best way to sort of tackle this problem of understanding of risk is discipline. And so long as you get discipline into the picture, then you do tend to mitigate risk to
mitigate
a
risk
very
substantially.
great extent. So, Dhirendra, you've been a big fan of Peter Lynch and Warren Buffett. I still remember reading somewhere, you writing that maybe one of the first books that you read was Peter Lynch. So, some of what both Peter Lynch said and Warren Buffett said are timeless. Yeah. So are there, two of those things that you still remember today, which you believe are very, very relevant for even this generation of investors?
Absolutely. I think, and actually the value lies not in what they are saying, because that has been said by many other writers or authors or investors as well. I think the way it is written, Peter Lynch is more interesting, simply One Up on the Wall Street particularly, or, is written in a manner where, you understand the basic concepts in a manner which you can relate to.
Right.
He tells, the way it is narrated, the way you understand, the way you absorb, and that I think is a great lesson for how things should be taught, because it is not taught like an academician. It is taught like, narrating a story about a company which will be understood, because the key point which Peter Lynch makes, that if you can't really explain something to a 5-year-old in 5 minutes, then you can't explain it anyway, or it's too complex, to absorb or understand. So I think it's crucial. That makes it very valuable. Likewise, more than what Warren Buffett does or has achieved is very significant. But we should not forget that the magic of compounding, and he's 100-year-old, or Charlie, and the big tailwind to the US. All these things have contributed. But more importantly, what is likable about Warren Buffett is, once again, a story, and told in a witty way. So if somebody reads those 30 years of, or the owner's manual on BerkshireHathaway.com, that I think should be essential reading, primarily for the story, or, it is written like an edit, not an annual report.
So what you took away was, if you don't understand it, don't invest.
Don't invest.
And the second, what you took away, that's what you took away from Peter Lynch. And what you took away from Warren Buffett is, the magic of compounding always works. And if you need to tell a story,
yeah, they are great,
please tell the story so that,
stories are better understood.
Better understood. Say it in a way that's very witty. Oh, that's, fascinating. Two more questions, one is that, robo-advisors now, are the talk of town. And, many people do believe that maybe in the next decade or so, everything will be done by robo-advisors, especially, investment advice. So how do you see that evolving? Where do you see yourself in that space, or, the hand-holding psychiatrist in that space? Because a robo can't come and hold your hand, I suspect. I don't know. Maybe, life will tell us something different.
No, but, we have just experienced, COVID phase.
Right.
And we suddenly realized that you can really connect to 100,000 people
Right.
without getting out of your home.
Right.
And people can connect to you without actually reaching out to you.
Right.
The whole emergence of this multimedia communication system, which and a broadcasting system, and it makes every individual as a publisher your Twitter. So I think, and all these are multimedia vehicles. So you can play that role, not in the same way that I take an appointment and come to your home and actually
Press the bell
press the bell and come over. But now that can be done in many ways, because the key goal is to actually communicate, and the key goal is to communicate in the right context. Sometimes this role can be played. And about Robo-Advisor, your first question, it is not that it will happen or not. In fact, we can't do without it.
Okay.
Because if you think of an individual to be served by another individual, and he has to start with his 5,000 rupee,
Right.
it just won't be worthwhile for that individual to be served by this guy.
Right.
It simply won't be economically viable. And the next best thing is that he will get conned by something or the other which will not work out anyway. And the next step is, Robo-Advisor, because you will get close to whatever, whether you buy as I was saying, that form the habit. Buy an index fund, get with an aggressive hybrid fund, or if you are accidentally able to choose a good diversified fund, nothing like it. But even if you start with a sectoral fund, you will still be better off. So Robo-Advisory is inevitable. Robo-Advisory will be far more intelligent than what it is. It will, with Robo-Advisory, we envision something which will be completely mindless and just come and do it. No, with artificial intelligence coupled with Robo-Advisory, I think, it will be, and I think, I have this hunch, and there is a basis to it, that it might be more useful and more impactful than a human advisor. Because finding consistency in quality of human advisor, there is an element of risk. You might end up with a brilliant one, you might end up with an average one, and you might end up with a crooked one. Here you will at least be assured that, okay, there is a process and a method being followed which will be true to at all times, right, and which can improve with times. So my sense is that, it will have a far greater appeal than what we are thinking right now. And other back-end issues have been, reasonably resolved.
Right. So Robo-Advisory is here to stay and only get better in time, but there will still be a person behind the robo who will have to sort of understand how the human mind works.
You have to configure the robo, and that will be a function of how experienced, how intelligent, how thoughtful, how aligned you are with your investors.
Right.
Thought.
Right. Okay. So let me end with the last question. Now, if there were two pieces of advice that you would give, an individual first-time investor, what would they be?
Oh, that is what I was saying. Get started anyway,
right,
somehow.
Yes.
I would like to give 3-4 of them. Don't look for excuse that, this, that, index, non-index, good fund, this fund. Do this, just get started with a fund. Second is that, make sure that this is the money which you are unlikely to need for next 5 years. Because if you start and you are likely to need that money in 8 months or 11 months, you will not be able to stay the course.
Right.
So having a right premise is just as crucial.
Right.
And if it is your 8 months money, put your money in a debt fund. Right. It will be better.
Right. So, okay. So now that you mentioned debt funds, I think it would be incomplete if I didn't ask you this. In this conversation, at what point of time in life would it be a good idea to move part of your allocation out of equity into debt?
It could be at any stage of life, but not in the first 5 years.
Okay.
Because you need debt anyway. You need debt for 2 reasons. One is to bring stability to your overall portfolio. And second, your money should be in debt, the money that you need in the next 1 year, 18 months, and so on.
Right.
Your short-term requirement should be in debt, right, so that it is not dependent on market.
Right.
You can't be left to the market for your key goals.
Right.
Why, after 5-6 years, why allocate and de-risk yourself when you have nothing to lose?
Right.
But in the initial stages of your allocation,
right,
and then how much money should be in debt to bring stability to your portfolio entirely depends on your temperament. Okay. If that money is very crucial to you and you get very upset, you lose your sleep with 10-15% decline in a month's time, then maybe have 30%, 40% fixed income. If you're not getting upset, you are enjoying the ride, but there is another advantage why you should have debt. if you don't do allocation to fixed income, when you have something meaningful. So for first 5 lakh rupees, 10 lakh rupees accumulation, don't bother. After that, think about it. Think about it for 2 reasons. One, you will have money to rebalance. Money to rebalance ensures that you are able to buy low and sell high.
Right.
Because rebalancing, that is the standard fallout of that. And you will always have money to buy low, and you will always have money to sell when it is high.
Right.
And maybe this can add about 3 to 4 percentage point advantage to your long-term investing.
Okay. This has been a very fascinating conversation, Dhirendra. Thank you so much for all the valuable insights that you gave me and all our viewers. And I think today I'm reminded of a quote of Warren Buffett, where he says that, and I quote, "I don't look to jump over 7-foot bars. I look around for those 1-foot bars that I can step over."
Mm-hmm.
Yeah. So in Dhirendra speak, that would be boring is good.
Yeah. In fact, my book published by Juggernaut is, Boring Guide to Mutual Funds.
Right.
And I would say that, investing should be looked more seriously and not being looked upon as a game. And doing things with simplicity can translate into something very substantial. And I think, it's very important for people to absorb that it's not a game. Your real life goals depend on it. Right. Take it seriously.
Thank you so much, Dhirendra.
Thank you. Thank you.